If I had to start all over in trading today, here is what I would do differently. I've been in the markets for over 25 years, starting as a financial analyst and then working in fixed income at JP Morgan, and later trading equities, options, and even futures as a proprietary trader and a portfolio manager. Now, throughout my career, I've seen every type of market environment, every mistake, and every opportunity. In this video, I'll take you through my journey, how I developed my trading process, and the lessons that you can apply to your own trading. I first got involved in the markets in the late 90s during the dot-com boom. Like many traders at the time, I was caught up in the excitement. Stocks were going up every day and it really seemed like an easy way to make money. But when the bubble finally burst, I quickly realized that luck was not a strategy. I needed a structured, repeatable process that ultimately will put me on the path to truly understanding market behavior, risk management, and investor psychology. But the real true turning point for me didn't come until I started working on Wall Street at JP Morgan. You see, I always had it as my goal to work on Wall Street, and I worked very hard to get that job, and I'm forever grateful that I was able to see exactly how the sausage is being made. You see, when you work on Wall Street on one of those actual trading floors, you see things you can see nowhere else. You see who is buying stocks, bonds, commodities, how much they are buying. You might even find out why they're doing so. You see deal flow, issuance of new bonds, stocks, IPOs, deal flow of all sorts, and all sorts of analysis and interpretations from market players that you simply can't gather anywhere else. And so this really introduced me to the importance of being able to analyze different asset classes because they're all intertwined. Just because I'm interested in the stock market, let's say, doesn't mean I shouldn't be understanding what's going on in the commodities markets or certainly in the fixed income markets. But it also gave me a true appreciation of understanding risk management and macroeconomic forces. Very, very importantly. When I started seeing all this stuff and all these people being very busy around me, being able to travel around the world with it, it just gave me a different sense of the complexity that markets really are that you don't see until you actually work inside of one of those investment banks. And then later on, as a proprietary trader and portfolio manager, I started to develop strategies that were designed for different types of environments in the market. You see, the market and the economy has a cyclicality to it. And to think that we can use the same exact trading or investment strategy in any of these parts of the cycle is simply an oversimplification. It's not how things work. The good news is that once we do know what kind of strategy works in each type of environment, most of the hard work is done for us and we can just go ahead and apply it. But when I started analyzing the market and actually being in the market as a proprietary trader and portfolio manager, it started becoming very clear to me that most people strike out because they're not able to adapt to a new market environment. And that's really critical to being successful, not just in any given month, quarter, or year, but really for longevity and being able to actually grow one's wealth in the markets. You can think about it this way. If you have a pair of ice skates and you say to yourself, I'm now ready to do winter sports, well, you're ready for ice skating with ice skates, not very helpful for, let's say, skiing. And so it's the same idea in the markets. If you say to yourself, I am good at buying growth stocks, for example, which is something that of late has been something that has worked for quite a long period of time. But that's not a very helpful strategy for when we are in a cycle or going into a cycle where all of a sudden growth stocks might not work for 1, 2, 5, sometimes up to 10 years. This can happen. And so what I came to the realization of is after working at JP Morgan and moving on to the portfolio manager side is that the successful portfolio manager and the successful trader and investor at home is the one that adapts to a new market environment. So for me, the number one thing that I'm concerned with every single day is understanding what type of market are we in. What does it look like in terms of volatility? What does it look like in terms of focus? Is the market right now focused more on equities, more on interest rate sensitivities? Is it geopolitical risks? Is it something totally different? And once I know that, the odds of me having a profitable week, month, quarter, and year dramatically increase because I'm not or no longer fighting the prevalent trend.
And this gets us to my morning routine. Now, as I said before, I think one of the more important things that I've learned over the course of my career is to understand what is the market environment that we're in. And so when I wake up in the morning, I need to make sure what is going on in the market more broadly speaking. On the screen here, you can see a dashboard that I created that I like to look at, where not only do I certainly need to know, at least to some extent, what are the news, but I do need to get a feel for what's going on in global markets. Now, one thing I definitely want to be having a handle on is what are bond yields doing? Not just the United States, but I do like to know what's going on, for example, with Japanese rates, European rates as well. Very important to understand is what's going on in commodities. So I need to make sure I have a handle of what are some of the major commodities doing. Is there a big move that I need to be aware of in things like precious metals, gold, silver, maybe energy stuff, oil, natural gas, and other parts of the commodities markets as well. And then, of course, the big one to kind of all together ends up being currencies. I'm not a huge currency trader myself. I do have some positions on every once in a while in currencies from a macro perspective, but I need to know, most importantly, what is the dollar doing? The US dollar, is it up? Is it down? How does that tie in with the equity markets, with what's going on in rates, trades? So that's really important. Also important is, for me, from a US equity perspective, I do want to know what are the different constituents of the US equity market doing, meaning how are, for example, financial stocks looking for the past 3 months, 6 months, 1 day, 5 day. Same thing for other parts of the market as well. So that is what I'm liking to look at as far as the dashboard is concerned. On the news front, as I said, I do like to have an idea of what's going on in the news. Obviously, it's not unimportant, maybe a little bit less important than a lot of people think, but it is important for me to know what are the economic releases that day and maybe that week. Mostly here we're concerned with US economic data. That's not to say that other data is not important. It certainly is. It's just that from what moves the markets most, as a global investor, it does tend to be the US economic data. Then the next thing for me is before I even get to specific trade setups, I need to make sure what are the major trends. I have developed an algorithm that tracks trends across the world, be that from individual stocks like Apple to individual sectors, currencies, commodities, equity markets around the world, fixed income, and so on and so forth. And so if you look at the chart here, you can see, for example, the NASDAQ 100, you can see how the trend changes over time, whereas a green trend, meaning a bullish trend with trend following buy signals along the way, then a neutral trend, which is denoted here with the black background color, then finally into a bearish trend, back to a bullish trend, ultimately, and then as of when I'm recording this here, back into a neutral trend. And what this allows me to do is just risk manage much better what is the broader environment. So if you look at this closely, you can see, for example, at the time there, the equity market started topping out. A lot of economists and people, that market commentators who are always eternally bullish, that's their job again, going back to the importance of understanding there's a sausage made, which I was fortunate enough to learn working on the trading desks, on the trading floors, I should say, at JP Morgan around the world, allowed me to really understand that, and also understand that most economists, most market commentators tend to be way late on that. So I need to track this myself. And so that's important to know, because when risk is off and people are remaining internally bullish, I like to focus on data. And this is really important, because when we focus on data and data only, we have an ability to keep emotions at bay. Whereas if we are constantly at the mercy of what's the latest market comment coming out any given day, we cannot remain objective, but we're constantly jumping from headline to headline. But if we do this in a data-driven manner, then it would have allowed me to stay bullish. For example, here from May 2023, all the way until essentially February of 2025, before the market, in this case the Nasdaq 100, turned into no longer a bullish trend, in fact a neutral trend. So that's important for us. Now that we've done all this, the next thing I really want to do is I want to make sure I start looking for specific trades. And for that, there's really two specific trades that we are looking for. One, we're looking for momentum trades. And two, we're looking for stuff that's extremely overbought and extremely oversold. And so when we look at those two types of trades, here is what this looks like. What I have built also, again, proprietarily, is essentially two algorithms, two indicators. One of them is a momentum indicator, and the other one is a extremely overbought, oversold reading indicator. And not only do those indicators have specific entry points, but there's also very specific exit points. So for example, here you're looking at the S&P 500, and when we received a fresh new buy signal, it also at the same time gave me a profit target, which is those green dots up there, those horizontal lines that you can see. The S&P 500 ended up going from that little green area there all the way up there, reaching its profit target all the way along. I have a trailing stop, which is here denoted with those red dots. That is one of the most important aspects as a trader, is that I'm able to capture momentum trades. Momentum trades is when a stock, an index, a currency, commodity, what have you, all of a sudden starts to accelerate at the speed at which it's going. It's either moving to the upside very quickly or moving to the downside very quickly. When I can capture that delta, that is one of the juiciest positions to be in as a trader. So I want to make sure I capture as many of those any given day, week, month, and year across the different spectrum of asset classes. That's momentum. The other thing that I'm looking for every single day, and I also developed for this in a proprietary indicator that we were actually working on at JP Morgan as a side project. And with this particular indicator, with this strategy, what I'm looking for every single day is what is extremely oversold. Where can I take the other side of human emotions and start buying for a trade that may last a couple of days or a few weeks? If it's intraday, it's obviously maybe just a few hours. Or where can I take the other side of human emotions when everyone is extremely bullish and I have to probably actually sell? Like if, for example, if you look at gold here, just as I'm recording this the other day, everyone got bullish, and I actually received a signal to sell or buy some puts in it. So that is my routine that I go through every single day using our repeatable process for the markets. So if I could go back in time and give my younger self some advice, it would be these three things. Number one, you have to adapt to the market's environment. As we said earlier in the video, every single market environment has its unique characteristics and requires a certain set of tools and a certain set of strategies. It doesn't have to be overly complicated, but just understand that if the market's just pushing higher every single day and we're in a raging bull market, that is a very different environment requiring a different strategy than if we are in a down market or a sideways market. And don't fool yourself. These market environments don't just last for a week or two, they can last for a long time. So if you've never seen a sideways or down market that lasts for more than a week, believe me, they can. And that's why it's so important to be able to adapt. Number two, risk is first and then profit second, meaning risk management, protecting our hard-earned capital has to be the number one focus. I see so many people coming into this business where they're mostly focusing on the profits, and with disregard for the downside, for the losses, and that is typically a function of them never having experienced an extended period of time of drawdowns. And the goal for me is to always just stay in the game. Most people that come into the market see this as a longer term activity, meaning they want to do it for a long time, but being able to stay in the game requires us to be able to protect our capital. So don't lose money, lose a minimal amount of money is really, really important. And that really starts with a mindset of risk management. That is number two. And thirdly, a repeatable process. It's easier said than done, but it doesn't
have to be overly complicated, as I said before. Being able to have a process that allows for a structured, rules-based approach, not only for analyzing the market, but then also ultimately for when we get a trade or investment signal, having specific profit targets, stop losses, and having that repeatable process not only allows for much better risk management, usually results in way better results over the course of time. More importantly, it allows us to keep our emotions at bay and really makes us confident traders and investors. And if there's one thing I've learned over the course of my career is that having that repeatable process, something that gives me a lot of confidence in my abilities to navigate the markets, is really priceless and ultimately allows us not to be greedy, not to be fearful, but to be a repeatably profitable investor and trader in different cycles. If this video helped you, please make sure you subscribe to the channel, you give us a thumbs up like, and if you want to see this approach in action, you will want to join us in our Set the Market morning call, which happens at 9 o'clock Eastern Time, Monday through Thursday. Make sure you join us for that in the link down below. Again, subscribe to the channel. I'll see you in the next video.